Good evening, everyone. I hope we can hear me. If you can, kindly raise your hands to confirm that you can hear me, please.
We can hear you. Good
Can you
evening.
hear me, please? Speak up. Let's hear you. Please raise your hand if you can hear me so we can have a start at this. Alright, thank you so much. Good evening and welcome to another session of tutorials with Next Gen Professional Associate. I'll be taking you through your class tonight, and we shall be looking at this very important standard. That's talking about IS 36, which has to do with impairment. You know, it is one of the standards you must cover for you to write and pass your exam. And so, quickly, let's run through what it's all about. When we are talking of impairment, what it is all about. Before we move to that next slide, just what I want you to do is please have a writing pad beside you and listen and jot something. It's very, very important. Now, let's quickly run through. When we talk of impairment, under this standard, we shall be looking at the definition of terms. We shall be looking at sources of or indication of impairment. And we shall be looking at individual assets as well as cash generating unit assets, and then the country treatment when there is an impairment loss. That is what we shall be looking out for in this standard. And so, quickly, let's run through the definitions of terms. Definition of terms. According to IS 36 impairment, an impairment is said to occur when the carrying value or the carrying amount of an asset is higher than the recoverable value or amount. In summary, what we are saying is an impairment is said to occur to an asset when you have the carrying amount of that asset or the carrying value of that asset, which is also known as the net book value of the asset, in the state of financial position higher than the recoverable amount of that asset. Now, take for instance that maybe the net book value of a plant and machinery for the financial year 2023 is 20 million. But then you carry out some impairment reviews and discover that the recoverable value of that asset as we speak is now 18 million. The simple implication is that the carrying value or the carrying amount of that asset is currently now higher than the recoverable amount. Remember what I said was the financial year 2023 carrying amount of a PPE is 20 million. But then when we carry out impairment test and when we got our recoverable value for that same asset, we discover that it is now 18 million. It means that the carrying amount or the carrying value of that asset as at that financial year was higher than the recoverable value. So that is that for that. So when the carrying amount of an asset is higher, it simply means that there is a loss in value of that asset. That is the simple meaning of impairment. And so therefore, what you are considering are just major two things. The first one is the carrying amount of an asset, and the second one is the recoverable amount of that asset. So what is the meaning of recoverable value or recoverable amount of an asset? The recoverable value or recoverable amount of an asset is the higher of the fair value less cost to say and the value in use for an asset. It's as simple as that. Recoverable value is the higher of either the fair value or the value in use of an asset. That is how simple it is. So what is fair value? Because I know that will be the next question now. So when we talk about fair value, the fair value is the price that normally you will receive to sell an asset in an arm's length transaction. In an arm's length transaction, that is where there is an orderly transaction between market participants at a measurement date. That is what we refer to as arm's length transaction. So the market price that you will receive if ordinarily you want to sell an asset, that is what we call the fair value of an asset. And that is the market price of an asset less cost to sell the asset. That is what we know as a fair value. Whereas value in use simply means if you are to continue to use this asset in your business, what are the estimated future cash flow for that usage? What are you estimating? What is the cash flow that you are estimating? When you're able to estimate that cash flow, you discount it into today's present value. Class, I hope we are still together. Just raise your hand if you can see me.
Yes, sir.
Thank you so much. So that is that for that. So we have recovery value to be either the fair value of an asset or the value in use of an asset. That is that for that. So also you need to understand that there are ways and manners by which you need to go about review of an impairment or accounting for an impairment. And then that is what I call the stages of accounting for an impairment loss. Impairment, as it were, like I said earlier, is a loss in value of an asset. So there are various stages, but I break them down into 3 stages when you are accounting for an impairment. And stage 1 is that you need to establish whether there is an indication of an impairment. You need to ascertain if actually there is an impairment in place. And the step 2 is you calculate the recoverable amount of the asset if you have discovered that there is certainly an indication of an impairment. We are going to look at those indications, those sorts of indications, those things that tells us if an asset is actually have that indication of being impaired. We are going to look at it. And then number 3 stage or step that you take is you compare the current amount with the recoverable amount of the asset, and then by it you determine if there is an impairment. That is that for that. So 3 stages are involved. The first one is test if there is an indication for impairment. Number 2, calculate the recoverable amount. And number 3, compare the current amount of that asset with the recoverable value. So quickly, what are the indications, the sources of indication that an asset have been impaired? This can be divided into 2 as follows. We have the external indicator, and then we have the internal indicators. External indicators and then the internal indicator. The external indicators are the following. Number 1, when there is an unexpected decline in the market value of an asset, that is one of the indicators that there is an impairment. When there is an unexpected decline in the market value of an asset, just know that that asset is already declined. This can happen, for instance, now if the market value for the equipment that is being used to produce cement decline in value, it means that definitely the carrying value of the plant that you have as an entity will be higher. That is, the net value of the plant that you have will be higher because there is a decline in the market value of that asset. Another very good source of indication is when you have increase in interest rate, increase in inflation rate. All of these, they will always lead to sources. They will always lead to impairment of an asset, reduction in the market value of an asset. That is, an asset being overvalued. Also, when you have changes in technology, it will lead to reduction in the value of an asset. Equally, when you have changes in government policy, economic policy, laws and regulations, all of these can lead to the value of an asset declining over time. Those are the internal sources of internal indication that there is actually an impairment. And then we have another one which is the second category, which is internal indicators. Internal indicators that there is an impairment of an asset. Number one, when there is an evidence that an asset has been damaged, when there is a damage to an asset, definitely the value of that asset will be reduced. Take for instance, even your phone that you are using. Once you buy your phone and the screen crack, if you want to sell it, whoever that want to buy from you will not buy it at that price that you want to sell it. Why? Because there is already a damage in that asset. Is that not so? That's how it is. Also, another internal indicator is that when an entity decides to discontinue an operation, maybe a unit or a department, for instance, that definitely will make that asset to be redundant, and that will lead to an impairment. And then another one is that when there is a reduction in the useful life of an asset, please write that down. When there is a reduction in the useful life of an asset, that is also a source or an indicator of that there will be an impairment on an asset. And then also, when there is a going concern threat to an entity, that is, if an entity will not be a going concern, that is to say, they will not be in operation in the foreseeable future, when there is that threat that is visible, it means that we should test for impairment, meaning there is an underutilization of the asset as it was. So those are the indicators of impairment. Remember the stages as I've mentioned earlier. The first one is you must test for an indication. You must ascertain if there is actually an impairment. These indications must be available for you, must be handy for you. There are a lot of them. You can read more on them so that you can know them. There are a lot of them. Once you see that indication in place that there is an impairment to an asset, that is the first thing first. The first stage first. Then once you see that there is an indication, then the second stage comes to play, and that second stage talk about the fact that you must calculate, you must determine the recoverable amount or recoverable value of that asset. And then the third stage is that you compare them. You compare both the recoverable value with the carrying amount. When you see that the carrying amount of the asset is higher than the recoverable value, then you should know that there is an impairment. However, in the scope of IAS 36, it is important for you to note that you must continually test two major assets annually. Whether there is an indication of impairment or not, you must always test them for impairment. Number one is your goodwill in a business combination. Goodwill that is acquired in a business combination. When we talk about business combination, we are talking about merging of two or more companies, or where you have parent and then the subsidiary, or where you have a joint venture arrangement. When there is a business combination and goodwill emanates from it, you must test it for impairment on an annual basis, whether there is an indication of impairment or not. Number two, all the intangible asset that has an indefinite useful life. All of them that have an indefinite useful life, you must test them for an impairment annually, whether there is an indication that they are impaired or not. So that is that for that. Then quickly, let's move to how to calculate the carrying. We have been talking about carrying amount and their recoverable value. Let's quickly look at how to calculate them, and that leads us to what we call measurement. I've told us in the earlier class that measurement simply means calculation. Determine the figure, the value to attach to the line items on the financial statement. That is that for that. So quickly, what are involved? How do you calculate it? Calculating the carrying amount of an asset. In case you are given in your questions, or it is expected as a professional that you should be able to calculate the carrying amount of an asset anytime, any day. You can be given the cost. You understand? And you can be given the mechanism for you to calculate for depreciation. All that you need to know is that when to determine the carrying amount of an asset is just the cost minus the depreciation, or cost minus accumulated depreciation will always give you your carrying amount. And then to calculate your recoverable value, it is you first of all determining the fair value of the asset. That is the market price of the asset less cost to sell. This cost to sell includes the direct selling costs like legal fee, all these taxes, and all the costs that will warrant the asset to be sold at that condition that it is being proposed for sale. Understand that fair value does not necessarily mean that the fair value of an asset does not necessarily mean that you want to sell the asset. But we are saying that if you are to set the asset now, how much will you receive to sell that asset? That is what we know as a recoverable value. The amount that can be recovered if you are to sell the asset as at now. That is the simple meaning of fair value. And then the other leg to hit is value in use. Like I mentioned earlier, what we mean by value in use is that you have some asset in place, and this asset you believe that you are not going to sell it. But if you are to keep using the asset in the ordinary course of business, that is, if you are to continue to use the asset, you need to estimate the future cash flow that this asset will give to you. Take for instance, now you want to establish a call center and you are using you use phone. Definitely you are going to need an asset for you to carry out that call center business. That phone becomes your asset. Now if for instance you buy that phone for 30,000 naira, you understand me now, and then you want to continue to use this phone, let's assume now you buy the phone, let's say in 2023. That's when you bought the phone. You have used it in a financial year that ends in 2024. You now want to test for maybe for instance the phone have crack in the face. You understand? And then you now want to sell the asset. You now discover that you went to the market and discover that phone that you are using, they are now selling. You bought it for 30,000. Now give or take, you feel okay. By all things being equal, you want to sell it for 25,000. But you now go to the market and discover that they are selling that phone now for 23,000 naira. It simply means that the current amount of your asset is now higher than the recoverable value. That is the value of the asset. Now also that is fair value for you. Now value in use. Now assuming the phone, now you want to continue to use the phone as a crack in the face, you don't want to sell it now. Now you are expected to, you are saying, okay, you assume that you are going to use this asset for the next 3 years. It implies that you estimate what will be the future cash inflows to me. Cash inflows to me if I am to continue to use this phone. That is what we call value in use. Value in use means if I will continue to use this asset in my operation, what will be the cash flows to me. Now if you are able to determine that cash flows, you will now discount it into today's value, that is present value, because the future cash flow do not mean or translate into today's value. Looking at the time value of money, so you discount it using the implicit interest rate, or using the discounting factor that will be given to you. So that is that for value in use. So all of this that we are talking about under impairment, it's just for you to be able to ascertain what is the current amount of an asset, what is the recoverable value of an asset. You compare it. If the current amount is higher than the recoverable value, then there is an impairment. All that we have been discussing so far, we are talking about an individual asset. We shall still look at where we have what we call the cash generating unit. A cash generating unit is when you have a combined asset, identifiable, independent, or a small group of an asset that is identifiable. You understand? And they generate their own cash flow. That is, they generate their own cash inflow independent of other assets. That, for instance, now if you want to, all of the assets put together, all of them are generating their own cash flow. That's what we call cash generating unit. When we get there, you have the understanding better. But quickly, for under this individual asset that we are considering, let's look at an example so that you have a better understanding. Is there anyone that is having any question before we go to that example? Any question from class? I'm sure it's very well explicit and we all understand. Are we together still? Thank you very much. Adekoya, you are raising your hand. You have a question to ask?
Yes, sir. I just want to know the opposite of impairments. That is, if the recoverable amount is higher than the carrying amount, what would you call that?
That's a gain, and that we can refer to that as a revaluation surplus.
Okay.
That's a gain, as it were. Is that token? All right. Thank you.
Yes, sir. Thank you.
All right. So let's go ahead and look at an example now. Please, if you can snap it on your phone, you can go ahead and screenshot it. So let's look at this example. Example 1. You are the finance officer at I Must Pass ICANN, this diet PSC. As your resumption, having passed the just completed ICANN exam, you are informed that there is a machine in I Must Pass ICANN statement of financial position with a carrying amount of 300,000. In this question now, they have even helped us to understand what is the carrying amount. They told us that the carrying amount is 300,000. But the further information now told us that the machine is used to manufacture company best selling product range. But the entry of a new competitor to the market has severely affected sales. Please note this point. Let me read it again. The machine is used to manufacture the company's best selling products. But the entry of a new competitor to the market has severely affected sales. Please note that. Note that as we proceed. Now let's read further. It says, as a result, the company believes that the future sales of the product over the next 3 years will be 150,000, 100,000, and 50,000. Then the asset will then be sold for 25,000. When you see something like future sales, you should know that by this question, you are going to determine what we call the value in use. They have already given us our cash flows. But one thing that is not here now that we have not yet seen is the discount factor that we will use for us to get our cash flow, the present value of our cash flow. So let's read further. The now told us that an offer has been received to buy the machine immediately for 240,000 naira. But the company will have to pay a shipping cost of 5,000 naira. So now this 240,000 naira, who can tell me what is the meaning, class? Who can tell me what's the meaning? Raise your hand and talk, please. This, they say there's an offer for the machine for 240,000, but the company will have to pay a shipping cost of 5,000 naira. Please, class, help me out. What is that cost?
Transportation cost.
What is this price? What is, they said an offer have been received to buy the machine immediately for 140,000 naira. What is that exactly?
That cost is cost of sale. 5,000 naira is cost.
5,000 naira is cost to sale. Thank you. So what is the 240,000?
Fair value.
Thank you so much. That is the fair value of the asset. Thank you. You both are following me. I like that. Thank you so much. So quickly, let's go. Let's read further, and so that we can, add value and knowledge to ourselves tonight. They now told us that the risk-free market rate of interest is 10%. This 10% is what my class people. This 10% is known as what now?
Discount value.
Discount value or discount factor. Thank you very much. Wait. So meaning that our 150,000, 100,000, 50,000 will be discounted using 10%. Require. Identify, if any, indications of any impairment. That's A. B. Determine, if any, the impairment value. That is the impairment law. They say determine, if any, the impairment value. That is if there is an impairment loss. And this is a 20 marks question. If you have 20 marks, you are only looking for 30 and you pass your FR and you are in professional. Is that not so? You are not answering me?
Yes, sir.
Thank you very much. So now let's look at this solution together. It is to be answered by you now. A is to be answered by you. Is there any indication of impairment from the question? Anybody that can attempt? Can anyone attempt, please? Just attempt. Give it an attempt. Adiola?
Sir, yes, there's an indication of impairment.
Okay, give us now. What is the indication?
Because there's an entry of a new competitor.
Thank you
So
very
whether
much.
the
Thank
competitor
you
has
very
a
much.
better machine.
You have nailed it already. Thank you so much. That's what I want to hear. There is an entry of a new competitor. You have 3 marks. I have given you 3 marks. You are looking for 47. You have passed.
Thank you so much, sir.
Just claim it. Eh? Now you are passed. So that is the solution for A. I hope all of us will understand what she said. Okay, let's move ahead. Let's move ahead. The part B of the question says that we are to determine, if any, the impairment value. So let's go ahead. Now, I told you that you must follow 3 major steps or 4 major steps as it were when you are determining the impairment value. Number 1, identify the carrying value and of the asset. The carrying amount or the carrying value of the asset. And we were told, I've done the solution so that we can have a seamless class. You understand? Step 1, identify the carrying value or the amount of the machine. The carrying value is 300,000 naira. They have told us in that question. Step 2, identify the recoverable value, which is the higher of either of the fair value less cost to say or the value in use. So now let's quickly go. We were told that our fair value, the market price is 240,000 naira, cost to sale is 5,000 naira, the fair value is 235,000 naira. That is as simple as that. Then the value in use now. The formula to get your value in use is 1 plus, that is, to get your discount factor is 1 plus r raised to power minus n. You multiply by the cash flow, it will give you your present value. It's as simple as that. So value in use now, we have the year 1, 2, and 3. We have the cash flows, we have discount factor, and we have present value. On year 1, we have 150,000. Year 2, we have 100,000. Year 3, we have 50,000. But then they told us there is a resale value of 25,000. The asset will be sold for 25,000 naira. Meaning in year 3, we are expecting to have a cash flow of 50,000 and a resale value, which is also a cash flow of 25,000. I will have put 75,000 naira here, but I have to spread it so that you have understanding. So when you multiply by the discount factor, you have this present value, and then the total will give us 275,358 naira. Meaning that our value in use is 275,000 naira. Class, let me ask you now. Our fair value is 235,000, and then the value in use is 275,358 naira. Class, I'm asking you, what is our recoverable value? Please, in just few seconds, quickly talk. Adiola, if you can help us out, I will be glad.
Our recoverable value is the value in use.
The value in use. Moses
Yes.
Ufon is raising his hand. Why is this so?
Sorry, sir. I wanted to ask a question. We didn't subtract the cost of sale, the 5,000 naira that was supposed to be the transportation cost if we had decided to sell the asset
We
from
actually
the
subtract it.
fair value.
We actually subtract it.
Okay,
Maybe you did
okay,
not
maybe I
see
didn't.
it. See it here now. This is the market
Oh,
price
sorry, I
is
did not.
240.
Sorry, I'm sorry about that, sir.
You have seen it right now. So we have a fair
Yes,
value of
yes, I have.
235,000 naira. So what will be the recoverable value now? I'm asking you now. Moses, can you hear me? So what will be the recoverable value now?
Okay, sir. Sorry, sir. I think I was a little bit distracted. I think the recovery value should be the higher, whichever is higher. If the fair
So
value
which
is higher than
okay, so let me take you to the
the value in
recoverable.
use. Sir, can you please scroll so I can see
Okay,
your
now, okay. So now that means you are following me, and I thank you for following me in that way. So now let's go. This is now the value in use. Our value in use is 275,358. So Moses, what will be our recoverable value?
275,358, which is the
Thank
value
you
in
very
use. It is
much.
higher than the
Thank you so much. I've given you 2 marks. You are looking for 48 to pass your FR.
Thank you very much.
Just claim it. Thank you. So that is that for
Thank
that.
you,
So
sir.
you see how simple this thing is.
Yeah.
They are not something that is difficult. There was one of the question in one of the I've forgotten the diet now. they just said this question, it was a 15-mark question. As simple as it is, people did not know how to solve it. If you don't have the idea of it, you won't be able to deal with it. But you see that it's so very simple, right? And that's how financial reporting is very simple. Don't let anybody make you feel that financial reporting is actually very hard. It's what you can do and pass very, very seamlessly. So quickly, let's go to the cash generating unit, and so that we can close this class. I believe you have the understanding. So when we talk the ones, like I said earlier, we have been looking at an individual asset. Now when we now have what we call cash generating units asset, how do you treat it? According to our statistics, the definition is this. Please write. It's very important that you write. The definition is this: that the cash generating unit is that smallest identifiable group of assets that generate cash inflows independently from other assets inflow or group of assets. Let me take it again. Cash generating unit is that smallest identifiable group of assets that generate cash inflow independent of other asset cash inflow. A very good example is all these retail stores that have multiple stores across the various locations and the likes. For instance, what is that? This thing, ShopRite. ShopRite, you will see that they have different locations within the city. Now, those retail shops can be referred to as a cash generating unit. They have their asset, they generate their own inflow independent of other assets. That is a very good example. Another good example is these hotels that they have various operations based in other places. For instance, Transcorp now. We have Transcorp in Abuja, Transcorp in Lagos, Transcorp in Port Harcourt. So they are cash generating units. This simply means that they are generating their cash inflow independent of other assets of the entity. So that is that for that. And then their account treatment, the steps involved in determining their impairment is the same thing. The step involved is for you to test for their impairment, to determine if there is actually an impairment. Look at those indications. If the indications are there, you test it. But the difference also is that you will look at all of the assets together. You will not look at them individually. You will look at all the assets together to determine if there is an impairment. That is number one. Number two, you calculate the current amount of the group units together. That is the cash generating unit together. You calculate their current amount together. You also determine their recoverable value together. And then you determine if there is an impairment. The only difference between this cash generating unit asset and the individual asset is the way they allocate the losses, the impairment loss. Now, for individual assets, once you test them for an impairment and you discover that you calculate and then you discover that there is an impairment, what you do, the account is that you take that loss to the statement of profit or loss, another comprehensive income statement. That is where you will take it to nil it off. Now, note this, very, very important. Please note this, listen very well. If the asset in question, we are talking about individual asset now, if the asset in question have revaluation surplus before, and it is now tested for impairment, and then the impairment loss has been ascertained, you first of all recover that loss from that revaluation gain. Now, let me come again. If there is an impairment loss, first of all, you recover it from the revaluation surplus of an asset if that asset have revaluation surplus. And then, if the revaluation surplus cannot carry the whole of the loss, whatever that is remaining, you take it to the profit and loss account, profit or loss account, to nil it off from there. Whether that is profit made for that financial year or loss made. If profit is made, you use the loss to reduce the profit. If loss is made, you add the loss to the loss. It's as simple as that. But for cash generating unit asset, there is a way that you are to allocate their losses, their impairment, as it were. And you are located in the following order. Number one, if there is any goodwill in the cash generating unit, first of all, you nail the whole goodwill from that impairment loss. You nail it off from that impairment loss. Say, for instance, If, for instance, we have calculate and then we discover that there is an impairment loss of 10,000, and in that cash generating unit we notice that there is a goodwill of 8,000. The first thing first is we nil off that 8,000 to 0. We nil off to 0, and then we have a balance of 2 from 10 as impairment loss that is remaining. Now, the second rule is that these 2 that is remaining, you allocate it to all other assets that is remaining, all other assets that is remaining on a pro rata basis. That's how you allocate it. So allocate first to goodwill, that is number 1. Then allocate on a pro rata basis, that is number 2. However, there are clauses to all of this. There are clauses to all of this. And then the clause is that all monetary assets must never be impaired. Where you have anything like monetary assets, you cannot impair them. That is financial asset. Financial asset that will be treated under IFRS 9. When we get there, you have more understanding of it. But when you see that there is a monetary asset, or when they write something like financial asset, you should know that you cannot impair it. You cannot impair it. It's as simple as that. Please, it is important to have this basic understanding, and wherever ICANN is coming from, you can always deal with them. Whatever the exam is coming from, you can always deal with them. So quickly, let's look at an example under this cash generating unit, and so that we can have a comprehensive knowledge. Now, the following are the details of an oil rig which is treated as cash generating unit by Tinubu PSC. I told you it is a cash generating unit. Their assets are always combined. So we have property, plant and equipment 90 million, goodwill 10 million, other assets 60 million. The total is 160 million. They now told us that the recoverable amount of the cash generating unit, this cash generating unit, has been assessed to be 140 million naira. So they have already helped us to even calculate the recoverable amount. So we don't need to calculate it again. Require determine the account element of this cash generating unit. So from this question, before we even proceed, you can see that the current amount of this whole cash generating unit is 160 million. Is that not so? And then the recoverable amount is 140 million. Meaning that the current amount is higher than the recoverable amount, meaning there is what? An impairment loss. There is what? An impairment loss of how much? 20 million naira. And so therefore, that takes us to the solution. We have done with that step 1. We have been able to identify that there is what we call an impairment loss of 20 million. So how do you allocate it? You know, assuming this is an independent asset, what we just do is for you to take it to profit or loss account, another comprehensive income, and you are done. But since it is a cash generating unit, like I told us, it follows the sequence. And the sequence is that first of all, you lean off the goodwill. So from the question, we were told that the goodwill is 10. So first of all, we lean it up. That's how you have before the loss, then now the impairment loss allocation, and then the after the impairment loss allocation. So the goodwill before is 10. We'll take 10 from the 20. We have 0 remaining. Our PPE was 90. Now let's go to how we did the calculation so that you have a better understanding of it. This is how we did it. You know that when we take off the goodwill, the remaining amount is 10 million naira, and this will be allocated to other assets on a pro rata basis. I've told you that before. And so therefore, how do you do it? See, look at it here. Property, plant and equipment that we have, another asset, the two combined together, we know we have 90 million for PPB and we have 60 for other assets. So when you add 90 plus 60, you have 150 million. So 90 divided by 150 multiplied by 10 million is going to give you 6. And then other asset, 60 divided by 150 multiplied by 10 million will give you 4. And that makes us to allocate the 10 million remaining of loss and to this unit of assets. So that is how it is. So the loss shall be recognized as a loss, as it were. And so therefore, what you do with this kind of asset is you will go and reduce it. Look at it here. So they say we should determine. So look at it here. We have PPE, other asset. PPE is 6, other asset is 4. And then when you take it off, you have 20 total. And then when you take 20 from 160, you have the new value of the asset to be 440 million naira. So now the main thing that we need to understand is this: when it comes to cash generating units, this loss will be taken to the assets, and we will reduce it directly from the assets. But if it is an individual asset, you take it to your profit or loss account to nil it off. I hope you understand that one that I just made now. Do we understand it? Are we still together?
Yes, sir.
Come again.
Okay, let me come again. When you have a loss under this cash generating unit, you have to allocate it to the assets. That's what we have done here. The loss will be allocated to the asset, unlike when we are evaluating for the individual asset. Now, under the individual asset, we say when the loss occur, we take it to where the statement of profit or loss account. Is that not so? Another comprehensive income. That's where we take it. Is that not so? To recover the loss. Is that not so? But for cash generating units, the impairment loss they are taken directly. They are recovered from the asset directly. That is, we reduce the asset value, the current amount of the amount of the asset by that loss. Is it clear now? Am I confusing you? Speak now. Are we still together? Adiola?
So we are together. I think your question is for the person that objected earlier.
Okay. All right. Okay. Thank you so much. So that is all about IS 36 impairment loss. That is everything that you need to know. It's as very simple, as straightforward as it is. So the definition of an impairment loss, in summary, I'm just doing so. I'll summarize it now in 1 minute, and then I think we can ask our questions, and then we call it a day. So in summary, the impairment is said to occur when the carrying amount or the carrying value of an asset is higher than the recoverable value of an asset. And then the steps that are involved is that you must first of all, ascertain if there is an impairment. That is, you test for an impairment. And how do you do that? It is for you to look at the sources of or indication of an impairment on an asset. You look out for them, and when you are able to ascertain them, that is the step one. You know that you need to carry out an impairment test. Now you can be asked to define how to carry out or to describe how to carry out an impairment test. You can be asked that question. Once they ask you that type of question, your answer should be that to carry out an impairment test, first of all, you need to look at the indication of impairment. And when you look at those indications, and it has been ascertained that there is an impairment indeed, the next thing you do is to go and determine the recoverable amount or the recoverable value of that asset, and then you compare it with the carrying amount of the asset. And where there is the possibility that the carrying amount of the asset or the carrying value of the asset, the net value of the asset is higher than the recoverable value, there is an impairment. Very simple and straightforward. And then for the individual asset, when there is an impairment loss, you take it to the statement of profit or loss, another comprehensive income, to recover it. But if it is a cash generating unit, you allocate it first of all to goodwill. And if goodwill cannot carry it, you allocate it to other assets on pro rata basis, meaning you are reducing the value of the asset directly. And that is that for that. Any questions before we shut down the class this evening? Any question? Adekoya, please go ahead. Adeola.
Sir, please, I just want you to please go back to the first
Thank
question.
you very much for.
Please hold on, Sunday. Please hold on. Let Adeola finish, please.
like I want to see the solution to that first question that we solved, like the discount factor parts. I didn't really, I didn't write out something, so that's just what I wanted to ask. If you can go back so that I can just maybe take a picture of the solution of that first question.
This is
The
why I told
discounted.
you people should buy the material. Everything is inside the material. Buy the material.
Ah,
It's
this
just
is my
one.
first class, so
Uh, okay. Oh.
I
Look
just
at it.
went for the first time.
I think we are there now.
Yes.
All right,
Excuse me, sir.
Mr. Sunday James, please you can go ahead with your question. Please, Moses, hold on. Let Sunday ask his question.
All right, sir. Thank you very much. I just came in a few minutes ago, and trust me, I enjoyed what you have just discussed so far. But my question is this: I just want to know the indication of impairment. How to determine what is the indication? What are we to be looking up to, as when it comes to impairment? The
Okay, thank you.
identification, sir.
Thank you very much. Adiola is in the class. Please, Adiola, please explain to him. Adiola, don't keep silent
Hello?
now.
Sir, sir, okay, good.
Oh, yeah, yeah.
He said, how do we indicate if there's an impairment, right?
Yes,
So
the sources of indication.
we have external and internal indicators that we can use to determine if an asset has been impaired. First, like the question we solved. Okay, should I use that one or I should list them out?
Just list them out.
Okay, so
Mention external.
change in
Mention
technology.
external.
Okay, for external now, a
Yes.
change in technology can actually indicate that an asset has been impaired, can be has been impaired.
Okay.
Changes in government policies,
Okay.
economic factors, and all
Okay.
of that. Then also, if an asset is overvalued in the
Yes.
statement of financial position,
Mm.
it can also indicate an impairment. Then also, like if there's
Hold on. Before you go ahead, let me quickly speak on overvalue of an asset. Overvalue of an asset is when you do revaluation and you use wrong indices. You do revaluation of as an asset. You now use wrong indices, and then by that you increase the value of the asset. That is overvaluing of the asset. Definitely, when the chips are down, the reality will be done on you, and by that time you will know that you have overcarried the value of the assets. Is that understood? Please, Adeola, go ahead. Thank you.
okay, so for external indicate, sorry, for
Thank
internal
you very much,
indicators.
sir. I
For
think
internal
with
indicators.
your
Okay.
okay, right on,
Please
please,
allow
Adiola.
Adeola to finish. Oh, I've given her 5 mark. He must work the 5 mark. Oh,
So okay, for internal indicators, if the asset is no longer in use for the entity, it can indicate impairments. Also, if the performance of the asset is worse than expected, it can also indicate impairments. I think that's what I can remember, sir.
okay, thank you so much. Any other person I want to add? Another indication in the internal is when there is a damage to the assets. You understand? Or when an entity restructure its operation, or when an entity discontinue the operation. Those are also classified as internal indications. And then once that happens, you have to carry out impairment test. Thank you. Any other question? Okay, Sunday James, please go ahead.
No, I just thank you for the response, sir.
Okay, thank you so much. Any other question? Awobona. Sorry. Oh. Okay,
No
Adela, please
question.
go ahead.
Sorry. This is the first time I'm joining this class, so I don't know if you did any class before now. Whether there's a
Yes.
recording, so that those of us that we know they can watch them, can watch now.
Okay. There was one. The first class that was done by my colleague. I'm sure. I think the video have been uploaded on our YouTube channel. You can go there and then
So
watch the video. This one also that we have done to this evening. Of course, we are going to
Will be
also upload
uploaded.
it on the channel. You can watch it.
okay.
Please also subscribe. Invite your friends. We are doing this for free to help people. Eh?
Yeah, I've subscribed. I think I joined PM yesterday, so I
Okay.
subscribed yesterday.
The more, the merrier. Imagine that dead and alive, we have just 66,000 chartered accountants, and there are about 1 million accountants. So if you are not chartered, I keep telling my students, if you are not chartered, you are just like someone that went to that went to university to study law, but did not go to law school. Eh? Don't be that kind of lawyer. Be a
My
professional.
daddy used to tell me that if I'm not chartered, I'm just a bookkeeper.
Yeah, bookkeeper. Thank you. That day I've said the right thing. You are just a bookkeeper. Be a professional, and I'm sure that you are on the right path. Thank you so much for listening tonight. If there is no other question, we'll just call it a day, so I won't bother you.
Thank you.
Hopefully that by
Sorry,
Wednesday.
sorry, sir.
Okay, go ahead, Moses.
Sorry, sir. Okay, I wanted to know if Adeola has you've actually answered the questions I wanted to ask the first time. So you talked about that it's in the material. I just joined today,
Okay.
so I don't know if
I
you've
think the
actually
material,
sent
well, the
or have a
information for the
Telegram
material,
before.
you will see it on the WhatsApp platform.
Okay, sir. Okay,
The
sir.
information on the
Thank,
material, you will see it on the WhatsApp platform. And
thank you, sir.
all right. Any other question, please? Okay. In the absence of any other questions, I think we are going to call it a day here. Thank you so much for the time, and I'm so grateful to have you. Have a very lovely night and very great weekend ahead. Thank you so much.